Thank you for coming for the FOF in person and also people on Zoom. So today we are departing from our regular programming. In case you would have gotten bored listening to PPFAs, people speak, we just thought we will get somebody who knows more about this topic than we could ever imagine to know. So Adwait Kasbekar, thank you so much for joining us today. And Yashodhan from our research team will be interviewing Adwait. I'll just give a brief introduction of Adwait. I know you have also seen the email, but I'll just introduce him in person. So Adwait has spent almost a couple of decades in the real estate field and in various roles. So as an advisor, as an investor, as a asset manager, as well as a development manager. So Adwait has been associated with organizations like Knight Frank, Island FS Investment Managers, JP Morgan, K. Raheja Group, and currently he is employed with SBI Cap Ventures Limited. Adwait is a civil engineer by qualification with a PG in construction management in real estate and a GMBA in finance from SP Jain School of Global Management. Adwait also enjoys reading, traveling, and spends time with his friends in his leisure time. Only one request Adwait has made to us, and I think it's a fair request. Adwait is not representing SBI Cap Ventures, so we should refrain asking questions about his employer. But rest of the real estate industry, which Adwait has spent almost a couple of decades in, I think it's open for conversation. Yash, over to you.
Thanks, Ronak. So let me just start the discussion by asking you about the groundwork which is required, to commence a project. So right from the time when, the idea of a project is conceived and all the way till the project is developed. So what are the different set of approvals, clearances, everything, that goes on behind the scenes, and who are the different parties that are involved in, setting the ball rolling?
So if you have to talk about the value chain of the project development, so it starts with getting obviously the raw material is the land. So I'm assuming that is there in place. So apart from moving from there, there are two parallel activities that will happen. One is you will have consultants coming on board, getting the planning and designing aspect sorted out. Parallelly, we will also go with those designs and get the approvals in moving. So that is a two-set parallel exercise that will happen. Moving from all the approvals in place, you will obviously go for construction. So that will have its own, depending upon the levels of and the complexity of the structure, that defines the timeline. And obviously, after everything is done, you need to get an occupation certificate and gets moving. So that's the life cycle. And in real estate, for even to complete this, to have a complete closure on this life cycle, you would require there are multiple stakeholders, so to speak, and those can be in the form of a consultants or can be in the form of a in-house experts. Those could be in terms of architects, structural engineers, then MEP consultants, licensing experts. So there are a whole host of list of consultants and who would be required as per the requirement of completing the project.
Okay, fair enough. So you mentioned about land, right? So land has a major influence on a project. So, getting the nuances like getting the right location for the land, how its proximity to key landmarks around. So could you throw some light on how does that process happen, and about title clearance for the land acquisition? So could you just throw some light on that?
Yeah, so again, it depends on, so as I mentioned, it's a key raw material where people would start building on something. So it becomes even the focus of attention for all the developers that they're looking at. And it depends upon what kind of business model he's following. Either he's doing a redevelopment project, so I'm just focusing on residential. If he's doing redevelopment project, or he's doing a joint development agreement, or has his own land which is historical in nature, or he's making a fresh acquisition and doing it. So for all these four categories also, there is a different set of requirements to be fulfilled. If he has his own land, he doesn't have to do much of a diligence. He's acquiring anything, so obviously he will go off to lawyers to get his title verification sorted out before he makes an acquisition. Redevelopment, it's more to do with getting the society approvals in place, conveyance in place, and everything. So all these four categories would have a different set of regulations or compliances to be done to get it. And be it in commercial, it's either you go along with the landowner, or you do it as a JD or in the form of an acquisition. So it's a similar for that.
Correct. So you also talked about the approvals and clearances which are typically required. So when you think about a timeline for a specific project, so considering all the approvals are cleared and everything, so what is the timeline you typically look at for a project?
So you were looking for
The whole approvals and everything. So what timelines are?
Yeah. So this is a quick slide to help you get some sense on approvals. So first of all, if I'm assuming that you're making an acquisition, so you have an ownership certificate getting in place, then there are building layout approvals. So everything related to project getting building plan sanctioned, and there are a host other approvals, at least 50-60 approvals that is required to get a you get an IOD for that. This is called an intimation of disapproval, and this is a typical for a Bombay or a Maharashtra project. This cannot be the same for all the regions. So every region has its own local nuances. So I'm just giving it as a representation for a better understanding. Then, so in Bombay standards, you get a kind of an NOC. So you get all those NOCs complied, and then you get a commencement certificate, which is to start construction. And then after every project is complete, then you get a completion certificate, and that's how you have a closure in terms of the compliance on approvals. Yeah, so this is a quick gist on, rather it's a, there are 50-60 approvals, but this would give you a fair degree of understanding of what kind of approvals are required, and also have tried to given a tabulation of number of days or months required to get the approval in place.
Right. So basically, environment clearance is something where the developer spends maximum amount of time.
Yeah. So so just to kind of give a perspective, for environmental clearance, there is requirement of at least 20,000 square meter of construction. So that triggers the qualification of environmental clearance. For a lakh and a half and above on a square meter basis, you have to go to center. So 20 to 1.5 is good. So it depends upon where you're getting qualified. The timelines differ, but you can easily consider something like in the range of 3 to 6 months, or what I've mentioned, 3 to 12 months. Yeah, depending on the complexity and the size and everything. So that becomes the critical element in the overall approval process.
Okay. So this is, the entire real estate development is kind of a capital intensive business. So if I have to, ask you, where does the capital majorly flow towards? Like, what are the cost structures look like for a typical real estate project?
So again, as I mentioned in the earlier example, there are 4 different models if I have to take a residential. If I have to be redevelopment, it's more towards the approval cost. And again, I'm taking a very standardized Bombay example, not a generic, but approvals, and then you would have a construction cost as the major constituents. But when you go towards making a purchase of land, obviously location makes a complete different dynamics to it. If you go to city center, your cost of land could be anywhere between 40 to 60% of the overall project cost. But you go to the fringe of a typical city, that can be in the range of 10-20%. So it all matters especially for the land cost, which location, whether it's the heart of the city or at the end, it defines the cost for your land.
Okay, so that's the major cost you're talking.
Yeah.
Right. So are there any differences in how a large developer would manage his cost versus a small developer? Because there are certain decisions involved where certain activities are outsourced. So a larger one would have probably the economies of scale to, outsource certain tasks and do certain tasks in-house. So are there any differences in terms of large versus small developer?
Yeah. So for a real estate development business, there could be 2 models which you can see. One is having a lot of activities happening in-house, and one where there would be a lot of outsourcing which can happen. So the first one, I would say, not the predominant practice, but a smaller sect of developers who would have a strong balance sheet or have larger number of projects to kind of substantiate the cost of having an overheads of say architects or civil engineers, or as a team where you could have multiple stages at multiple time frames, so you can reuse them and have an efficient use of the overheads cost. Vis-a-vis a small time developer who would be into one or two projects at a time and then moving on, not having a larger scale, for him carrying the cost of the professionals on board would add burden to his business plan. So obviously he would be looking at more of an outsourcing model, and it's a fair practice in the market where he would have a basic engineer or somebody who would look after the site, but for everything else as a consultants they would be hiring for getting approvals or getting into designing, or be it into execution. So that defines the scale of the group, and the scale of projects would define what business model he or she would like to implement.
To summarize, basically, the decision to outsource is this basically. I mean, there's no other reason why would somebody, I mean, are any other factors which go behind the consideration to outsource?
So predominantly this is the factor, because as I mentioned, in a life cycle, it takes different skill sets at a different point of time. So you would have architects and the licensing person right at the start of the project and probably at the end of the project. He and she would not be used during the project. There would be some help required. But if you have multiple projects, then that same resource could be used across multiple projects. So it makes easier for a small time developer to just hire when he requires, is on a call basis.
So the factors that we have so far discussed, so if I have to compare these factors, say from one region to another, say compare two states or even within city of Mumbai and say Navi Mumbai, so how different would they be?
For the
So stamp duty, registration, all the other charges, clearances. Approvals.
So real estate is a very local subject for various factors. So when you talk about anything different from location to location, that has its own variety of factors. So it starts from right from the development control rules. So defining what is the development that you can do on a piece of land, that completely differs from say Maharashtra to Karnataka, or maybe Bombay to Bangalore or Hyderabad. To a certain extent, within MMR, when generally people talk about MMR constitutes island, suburbs, Thane, Navi Mumbai, Virar, Bhayandar. So each municipal, and these are all municipalities. So even these municipal corporations have their own nuances to the development control, which would not be similar. Say 20-30% would be different, maybe by and large having the same connotation. So even the development potential within these regions are different. So that brings a lot of difference in that. Cost of approvals is slightly different across. And just to take, this is the local factor. So if I have to take across the states, say from Maharashtra to say Andhra or Karnataka. So in Hyderabad, just to give an example, so at least in Bombay, you have a very clear FSI, floor space index, for a given land, what is the multiple that you can build. That is absent in to a certain extent in Hyderabad, where Hyderabad has its own regulations by defining what is the ground coverage that you can have and what is the height that you can cap, and based on your design defines your development potential. So completely different aspect while arriving at total development on that land.
Right. So basically, to summarize, real estate is kind of a heterogeneous subject.
Correct.
So how is the choice of a specific project influenced? So let's say a developer with X amount of capital on his hand, how does he go about choosing if he wants to commence a project for real estate, residential side or the commercial side or the retail space? So how does he outweigh the unit economics and the profitability, and how does he manage his return expectations from it?
So to answer your first side of the question, what influences his development?
Correct.
What kind of product mix he would like to have? It depends on at least couple of factors, broad parameters. One is very cliched dialogue in real estate is location, location, location. So everything. So if it is a heart in the business district or where you have confluence of too many of transport, so obviously somebody would like to have and density around. So you would like to have a commercial or a retail or something to cater to that needs. Whereas a secluded, very very standard example. So you would have a residential development in that. So that commercial also would have. So that is one aspect, location. Second, I would rather put it as a balance sheet. It's very difficult for a commercial development with a weak balance sheet. So where the development requires a lot of capital coming in the form of your own equity or in the form of a borrowed capital. So that because of the revenue realization is only after the completion of the project if you're not selling anything. Whereas in residential, you can put a margin money in form of a 10-20% of your own capital, borrow 30%, and then balance 50%. You can run it through internal accruals from customer cash flow. So balance sheet defines the ease of approach. So you will find not many developers into commercial large scale development, whereas you will find a whole lost of even a landowner converting into a residential development and so on and so forth. So I think that answers your first part of the question. Sorry.
So the second question was about how does he outweigh the unit economics and how does he manage his return expectation?
So as I I will just take a typical residential example and try to answer this question, because again, since as you mentioned, it's a heterogeneous, so it's very difficult to kind of give you a very specific answer. But let me take an example and probably help you understand. So if I have to take a typical residential project, say anywhere in Goregaon or whatever, there's a location where a developer will put in his 20% of his contribution. He'll borrow 30 and he'll get 50. So 100 is the cost of a project. So he would at least expect a 30% gross margin. And I'm assuming that is something we'll make. So it's roughly about on 100 of total cost, he will make 140 as a revenue. So 40 on 20. So that is, and with a period of 3 to 4 years of construction. So that is what he's typically try to look at as a returns on his investment. So again, this can be 10, this can be 40, 50. It varies from various circumstances, but just to give an example.
Correct. So we have seen a bit of an interest rate movement in the past 1 or 2 years, and the interest rates are inching upwards. But if you look on a broad scale of like on a horizon of around 10 years or so, it might, the picture will be slightly different. So how is this exactly affecting the developers, the rising rates to say?
So yeah, interest rates has been fluctuating, and I think it went from, so the RBI increased it by another 2.5 or other 2.5% as a 250 basis points. So developers do get impacted. Again, it depends upon how leveraged the developer is, and again, I have to categorize between residential and commercial. So within residential, I have to bifurcate between affordable, mid-income, and say premium. Certainly, an affordable project would have a lesser margin to sustain as a business model, whereas a premium and mid would be in this almost similar range. Or so any quantum jump, and this was in a short period of time, obviously that would have certain bearing on the cost of running the project, plus the customers also coming from a low profile. So it has, so affordable would have some kind of challenges, but obviously demand supply would take care of that. So commercial standpoint, yes, if the balance sheet is strong enough, there is visibility in terms of a pre-leasing activity for a commercial anything. Though that can be absorbed over a period of time, which can be construction finance could be then converted into a LRD or some other thing. So they may have slight impact in terms of cost to or the loan to the value ratio, but I think that takes care. But that's how the impact would be, at least from a developer and the asset class wise.
Okay. So next I was coming to the same thing from the consumer side. How is it exactly affecting the housing sales? And as we see the premium and the luxury houses, that has, they're still resistant to what the increase in rates. I'm talking about the housing sales. On the affordable side, I think that has taken a hit, like you said. So, and again, if you compare different timelines, if somebody has taken a loan to go for, any house, say post 2020, the impact might be slightly different, and versus if you talk about the period between 2015 to 20. So, your thoughts about it?
Yeah. So, very interestingly, if I have to take a history, and this I've just borrowed it from one of the websites, I put the source there. Um, if I have to look at the history, and that is some indicator of how behavior of say customer and the interest rate is. So 2004-5, everyone knew that was the bottom of real estate, or rather the start of the surge of prices and the velocity of sales. Incidentally, that was the lowest point of interest rate, and that whole cycle went up till 2013-14, where it kind of peaked, and from 13 say onwards to 2020, it was a sluggish, even in terms of price movement or the sales velocity. And that was absolutely in the opposite direction of the interest rate. So it was the lowest in 2004, and when the market peaked, and the cost was about the mortgage rates were about 11 to 12%, and it even peaked at 8. 8 was the euphoria of everything, right? And the home loan rate was at 12%. So, and again, here in the period where the interest rate were falling, people should have jumped into buying real estate, but that's seriously didn't happen that way. So there is lack of correlation from the very near history that we can see. So what one can only conclude saying that the affordability and the pure movement of say a psychological comfort of having a safety in terms of jobs and the earnings and the savings, I think that would influence far more rather than the interest movement for the customers.
Okay, fair enough. So this sector was always known for all the illicit activities, misdeeds were, very common. The consumers, shareholders, they were taken for a ride by the developers, and consumers were losing faith. Investors, they had no confidence to, per se invest in this sector. So what sort of changes have been brought about in this space by the government in the past, say, 10 years or so?
So in my mind, there are two major changes that happened, and I think could take the top slots in terms of changes that could be brought about. One is RERA for sure, and second is REITs, the formation and the listing of commercial real estate. So these are the two changes, and I think it took also about a decade to kind of formalize and put in place. So, but that has revolutionized in at least in a decade or so.
So these regulations, RERA for that matter, I mean, has it increased the transparency and does it hold developers accountable enough, and does it plug the loopholes which were kind of evaded by these developers?
So a lot of challenges was from a customer standpoint, especially on the residential space side, where people were not sure. There are a lot of hue and cry from a customer standpoint that they've been cheated by various other activities from the development fraternity side. So what has happened in real estate is by introduction of RERA, is there has been a lot of discipline put in place. There is a lot of ring fencing activity which has taken, and a lot of transparency in terms of whatever the information related to the project is put in place, so that it empowers customers and everybody to kind of have an access and at least placate the fears that were there in the mind of the consumers.
Okay. So as such, it does provide the immunity and just brings in more confidence to the home buyers.
Absolutely. Sorry.
So it's very difficult to think about any industry without a middleman. So, every industry has like somebody who is brokering between the buyers, sellers. So how important and how integral are the brokers, the real estate agents to this particular industry?
So I would put it as intermediation as a aspect, and that happens across the value chain of say real estate development. So be it a land broking, identifying land, or be it in the form of say broking for a home, buying, selling of a house, leasing. So the brokers do add because of its old. As I mentioned, it's a fairly a local subject. Requires a lot of local understanding. That brings a lot of fragmentation in terms of the professionals who are working in that industry. So a lot of local knowledge cannot be kind of extrapolated to another region. So that kind of makes it a very localized subject, and that because of that, broking as a business plays a major role in say even residential. So for any typical project that you are trying to sell, at least 50 to 80%, in some cases even 100% of the units get sold by a broker. So again, depend on the grade A, B, C, D, and how is he dependent, how is he or she perceived in the market. It's all a function of that.
So I was asking about the commissions between, the structures between the developers and the brokers, and are there any caps as such as to what they decide to pay to the brokers?
So if I have to talk about purely on the residential sales aspect, it's a function of pull and push. It's function of location. If the brokerages are not standardized across location or across the geographies, it depends. As low as 2.5% is kind of acceptable in a particular micro market. It can go up to say 8 to 10%, and it's purely the dynamics. So obviously 2.5 is for the location where it is far more matured, information is there, and the transactions is far more easier to end. And in certain places where the geography needs to be, or the product needs to be really pushed to the customer, so the developer is kind of forced to kind of put a lot of instead of marketing efforts more on the brokerages to attract more sales and transactions. So it's a function of the quality or the location and the product which is acceptable to the market. So it's a push-pull is what I would like to mention that.
Right. So banks, they typically do not lend to these developers for acquiring a land, clearances, the major capex work that needs to be done prior. So that role was assumed by the NBFCs, and I think after 2017-18, most of these NBFCs, their financials were kind of dodgy. They were not in good financial health. So who has plugged in that gap if some of these NBFCs are not able to, lend to the developers?
So I'm assuming it's more on the residential side is
Yes,
what we are
yes.
looking at. Okay. So so if I have to look into the history of how the financing used to happen, so say from 2008, 9, 10 period, there were private equity players, there were banks, that was the two sector, and probably housing finance companies who were kind of warming up to do a lot of wholesale transactions. But 2012 to say 18 period, that was the emergence of NBFCs, and then even the alternate AIFs kind of came into the market. But NBFCs were more active in giving flexible, structured financing to the real estate, and obviously a lot of also was helped to kind of get the approvals or get purchase of land. After 18, 19, a lot of NBFCs struggled. There were few who were still sustaining, and they are still active in the market. But there was a vacuum created. Obviously, that was got filled by the alternate investment financing vehicles. So there are even private equity who are doing a lot of platform transactions. So the maturity profile has changed. Now NBFCs are taken over by either AIFs or a quasi-equity kind of structured transactions, and some NBFCs are still active. So that still take the load of investing into real estate.
So these different lenders that you mentioned, are they into the refinancing space as well? Because some of the loans which were earlier disbursed, some of these have come up for refinancing. So are these the same players who do the refinancing job as well?
So let me put in two ways. The ones which would have been say funded at the pre-construction, pre-approvals kind of a stages, that would have moved in the stage of construction, all approvals in place. So obviously the cost to kind of the cost of borrowing, obviously slightly on the higher side, is not justifiable given that the opportunity is only to construct and sell and complete. So that is a case of refinancing where a bank or any other low cost financing option available that would be to refinance it. But still in the earlier stages, then obviously it would be either a more expensive form of a debt in the form of an AIF, or another NBFC would be looking at opportunity, obviously looking at the kind of covers that would satisfy their investment needs. But yeah, the cost profile will completely different.
So the different lenders that you spoke about, the rates at which they are disbursing the loan. So what would be the difference in the cost of funding?
So as I mentioned, from equity to say equity, quasi-equity debt to say in the current form of say construction finance. So obviously the equity AIF, their expectations are somewhere about 18 to 25, depending upon what kind of investors they have attracted and what they are looking at the riskier asset and opportunities. So that plays that from 18 to kind of say 14, 6, yeah, those kind of ranges where the NBFCs and other AIs who has a play out there. But again, those are less riskier assets where they would have some form of a visibility or some kind of a structured solution which needs it. And obviously, construction finance ranges from say again 10 to 14% depending upon the profile of the developer and his balance sheet, he or she's capability in conducting the business. So again, depending on what kind of stage of construction, risk would define the profile and the cost for the developer.
So these lenders, do they cater to specific, I mean, if you could just categorize the lender and the stage to which they typically lend to. So early construction or, the development stage. So are there any lenders who typically lend only to that space?
So as I mentioned, if it's the early stages, there would be more of an equity nature of a call where jointly acquiring a land or getting into development. So that would require a private equity or a equity or quasi-equity kind of structure. So obviously the expectations are in the higher teens or beyond that. So that is the way. Anywhere somewhere in the between of post-acquisition to kind of getting the construction, say mid-stage construction, that's kind of an where stage where they would require additional help to pay more of an approvals and say smaller portion of approvals and larger portion of construction. So that would require a structured solution. So they would reach out to NBFCs or / as I mentioned it earlier. And obviously when everything is going, they just need a slight working capital requirement to kind of roll over the construction cost and have a mismatch in terms of collection, and that they would reach out to a construction finance, which would be a very low cost kind of a debt. So that's the nature of financing required at the particular stage of the say a project life cycle.
Fair enough. So internet has emerged as a major tool for the home buyers to do their research, to look at any properties and to reach out to developers. So according to an article on Business Standard, almost 70% of Tata Housing customers, they have reached out to the developer via the internet. So there are multiple property websites such as Magic Bricks, Prop Tiger, and they have received funding at crazy valuations. So and some of these, they only deal with property listings and few other add-on services, but there are very few who provide like a holistic service. So if you consider, the other services such as registrations, payment of stamp duty and all these other transactions which can convert to an online medium. So what are your thoughts about, this whole space going from offline to online? Because PropTech has been around for almost 2 decades and it's like a continuously evolving space trying to digitize itself in the unorganized residential real estate space. So what are your thoughts about the, movement from offline to online?
So all these players that you mentioned, Prop Tiger and so these are purely started as a listing companies with and then probably some of them have ventured into even a broking services. And you also mentioned about something called as an additional services to to complete the transactions or everything. So currently, so listing and everything is an old business, which now people have tried getting a lot of movement, say even broking or converting a transaction and online, but that has been a very slow process. Again, it's a high value transaction, so people are not really comfortable getting into the transactions only on a digital mode. So obviously some have converted into a broking, and still today on ground off the ground on the feet kind of a broking still plays a predominant role in the decision making of transactions and this thing. So that certainly takes a larger share of the value there. In terms of allied services, in terms of say verification of the property or say registration agreement, I think it's a work in progress. Slightly early in the stage. I think rental agreements is something which is happening online, but a fresh transaction of property registration or something. Right now, I I think it's just getting into a phase where the developers are allowed to even register from their office right now. So it's too early to call as a service available on the website, because there is a lot of negotiation, a lot of elements attached to it. So standardization is to a certain extent there, plus digitalization. So it will take some time. Probably in a work in progress. It will take some time to kind of get into that stage.
So basically, it's about the comfort level of a particular home buyer, because if you talk about visits, almost every month 8 million people are kind of visiting these websites. But if you talk about the conversions, they are pretty low, and the profitability of these companies also is not up to the mark. So is that the comfort level factor of the home buyers which is not, propelling these online portals?
Absolutely, because ask anybody who wants to buy a 2 crore flat in say Mumbai. I think he would be doing at least a research for next 6 months, visiting various sites. He wants to see what am I opening a kitchen window, what am I seeing outside. I open my living room window and see what I can see in outside, or so what are the amenities that I'm getting. So there are various other factors, and there's a huge capital which is going to be deployed. He or she is going to even take a mortgage on that. So it's a high ticket. Then it's a comfort of multiple family members. So it's all the factors put together requires multiple site visits. Even if when you talk to any marketing or sales person, you will see that a common feedback is that a transaction closes only after there are like 3 or 4 site visits. And after COVID and everything, the trend has been on the higher side. So it's not a simple transaction that you see on the website, like it, you click it and you buy it. It's not that simple. It takes a lot of on ground comfort for a buyer. So obviously it's more on the offline mode, predominantly offline mode. Yes, there would be instances of making small payments through an online channel, but there would be somebody, or the kaka, kaku, chacha, chachi, somebody going down and giving them comfort that even if they are, say, sitting in California buying a house, but somebody would be giving them comfort that the physically it looks great.
Absolutely. So one trend that was observed over the last decade is that the house sizes, they are getting smaller. On the contrary, the rates per square foot are increased. They are on the rise. So why is this phenomena happening, and is it mainly because of the cost of construction rising?
Yeah, there are multiple factors. One is cost for sure. The cost of constructing purely on the commodities, say steel, cement, those are kind of increasing. So if I have to take a typical case of Bombay, even the cost of approvals have staggeringly increased from say early 2000 to now. So that adds to the cost of development. And it's a pure function of developer. He tries to maintain, as a businessman, he will try to maintain his margin, and he will get a feedback from the market. So a typical buyer would like to have a 2 BHK or 3 BHK in 2 crores or whatever. He will take that feedback and go back and work his costings, go back into the drawing board, and he'll see if what fits. So what has happened over a period of time is something like a 2 BHK used to be a standard 750, 800 square feet or say 1000 square feet or say 10, 15 years back has now shrunk to as low as 650 and even lower. It's pure function of costs, like I mentioned earlier, various other factors. And again, it's also the function of what the customer wants within a tighter budget. So he's just doing the packaging for the customer.
Correct. So one of the slide which you showed earlier about the interest rates. So there was a strong demand until 2014. Post that, there was a lull in the market. Now again we are seeing the demand picking up. And if I have to classify the sales of affordable houses in the past 5 years, that has nearly halved. But if you talk about the premium and the luxury houses, I'm classifying them as everything above 1.5 CR. So the share of those houses that has doubled. And if you talk about the total real estate sales, almost 30% has come from the houses which are costing above 1.5 CR. So what are the factors which are contributing to this?
So certainly the inflation and say cost of living has taken its own share to increase the number of units selling at above 1.5 crores. But another factor, especially after the lockdown, is that everyone wants an additional bedroom. So earlier he or she was looking at a 2 BHK. Now they are preferring to have another additional bedroom, maybe a half or a full, whatever. So and even a 3 BHK person wants to move to a 4 BHK. So there has been an additional need of say either work from home or a certain sense of more space requirement or an additional room. So that has also played another factor that they're willing. And third thing is affordability. Obviously, from 13 to 21, there was say I would like to call it as a time correction. There was no real price going either northwards or southwards. They were kind of stagnant, and that brought about some kind of an affordability, which was say unaffordable at that point of time, brought out some affordability to it. So all these 3-4 factors put together would contribute for a higher sale in that kind of a say 1.5 crore and above kind of a range.
So this high demand that we talk about, it's almost at a decadal high. I mean, the yields on residential side would be around 2 to 3%. So how do they compare against the commercial properties?
So over my complete working experience, I have not seen rentals or rental yields or a cap rate, whatever you call it, for a residential very close to commercial. I have not seen it. It's a phenomena which I think is very much prevalent in the international market, which is very close by. In India, I would like to say that say a residential or a commercial has its two different these two sectors have its own, or two asset classes have a two different profile of people who are looking at it. So residential is a purely consumption driven product, whereas commercial is more of an investment driven product. So as I'm probably taking a cue from the same presentation that I mentioned, the interest rate kind of peaked, but the sales and the prices of residential real estate also kind of peaked along with it. So there was no real correlation that. But if you see, so last decade or so, where interest rate kind of fell from the highs of say 10 or 11 or 12% to as low as 6.5%. Your commercial real estate prices also kind of, or the cap rates also kind of compressed along with that. So these are more investment driven products, are more sensitive to the interest rate rather than residential. So comparing to cap rates would be a little slightly unfair to do that. But yeah, purely because of the consumption and the factors and no expectation to have a great rental income out of it, that could be one of the factors for having a suppressed say a 2 or 3% cap rate vis-a-vis a commercial.
Correct. So just changing gears a bit, and from residential side, let's come to the commercial side. So earlier in the developments that you talked about, you mentioned about REITs. So let me emphasize more on that. Now with the different investment options available to an investor, he can invest directly into REITs. He may choose to invest directly in a commercial property. And now the third way, that there are multiple options available to own a building fractionally along with a pool of investors.
Yeah.
So how do these investment options compare against each other, and which investor would prioritize what sort of option available to him?
Obviously, REITs, I think when it came along, there was some restriction in terms of 1 lakh rupee and above kind of transactions because it's the new product in the market. They didn't want to kind of have um, retail investors to kind of burn their fingers or something like that. But over a period of time, I think currently you can trade 1 unit now. So that has kind of given a comfort to SEBI or the regulators that this is more of a retail product now, and it's kind of stabilized over a period of time. So there is, whereas fractional is where there is, I think, the regulation on its way. There is some paper of discussion on that. But it's completely too different. So REITs has stipulations of say 500 crores worth and more. So you have multiple assets. You would have more of a risk diversification in terms of geography, nature of assets, neighborhood, nature of tenants. So a lot of benefits of having multiple assets and multiple income streams coming out. So kind of a slightly less of the risk from the investor standpoint. You would have more of a structured way of owner having some stake in that REIT. Then you would have manager, you have a lot of disclosures. So a lot of factors which go into REIT and then gets into the pricing of that. Vis-a-vis fractional ownership, currently it's in its nascent stage, growing, where they would require at least 10 lakh, 25 lakh rupees and above. A very sophisticated investor who would have little surplus income may want to kind of participate in that, but having too much of capital involved in that would be slightly risky or slightly on the riskier side. Then even the structure of this fractional ownership is not been tested, because which regulations cover this aspect of it it was unclear up till now. So probably a discussion paper from SEBI gives you far more clarity in terms of what regulations. So in the current avatar, it's completely different. So there is more disclosures here, there is less out here, there is a single asset focus. What happens tomorrow when there is a dispute? There is no clarity on how the dispute resolution would be happening, whether the Companies Act would be coming into the picture or what would define that. So and again, the most important aspect is the liquidity. So fractional is kind of illiquid. You are dependent on the service provider to find another buyer to your stake and valuation. So there are its own merits and demerits, but yeah. So I think
Fair enough. So if I have to compare between, say, a top-notch developer on the residential side, and then I compare the REIT. So in terms of access to capital and the cost of the capital, what a REIT would typically have. So how would they compare against each other? And do you think, the REITs have it easy?
So REITs as a basket versus the whole of basket of developers, obviously REIT would have a much better pricing power purely because of the disclosures and the information and the nature of the asset, stabilized rental income.
So it's mainly because they happen to be more on the
regulatory side. The balance sheet is far more robust. There is a restriction towards the debt that they can borrow, and there is a clarity in terms of say 90% or 80% of the assets are rent generating assets. So there is more stable cash flow from that asset. Whereas a developer would be looking at more of a speculative. When I say speculative, basically where he will go buy a land, go greenfield, borrow money, and then develop it till the stage of. So he will take a lot of risks to kind of come to that stage. So obviously from that aspect, the cost would be higher. But purely, if I have to talk about balance sheet, so even a stronger developer with a very strong balance sheet has a comparable borrowing cost to the REIT. But again, you have to be very selective about it.
Correct. So another most talked element in the REIT side is, or even the commercial property side, is about the grade A, grade B properties. So in terms of the cost and the structure in which they are developed, or the tenants that are typically a part of a grade A versus grade B property. So what are the kind of differences that you see amongst the two?
So typically when you talk about grade A, grade B, so there are multiple factors defining what would classify as A. There is no one point to focus on, but certainly one of the broader parameters that one looks at is obviously the age of the building. It's a young or a old building? So obviously older would have a slightly lower ratings, maybe in A negative or a B plus, whatever you can call it that way. Age, then design. How is the floor? Is it flexible to kind of make flexible office spaces or no, or is it more defined in a confined space where there is less of flexibility? Then amenities that are given into the building. How many lifts are there? How density versus the lift and the floating population in that building. So there are multiple parameters which, and then if is it a larger campus, is what are the other amenities given to it. So all this, and then ESG aspect is also very critical nowadays. So whether it's a LEED certified building, whether it's a silver, gold, platinum, again it all kind of adds up together to kind of define it as a AA plus kind of a property or a B category property.
Correct. So we spoke about rising interest rates, and so just wanted to understand to what extent does it affect the developer in terms of the cost of construction, and how easy it is for the developer to pass these costs further down the value chain.
So obviously interest rate adds to his costing. Interest of borrowed capital will add to his or erode his margin to a certain extent. He would love to pass it on, but at the end of the day, it again boils down to so by and large, developers would like to look at the market, what the pricing is, and then they would plan their product accordingly and they will place it accordingly. It's very difficult to add too much of premium. A very few select developers can probably do that. But by and large, the whole market would be a price takers rather than price setters. So, and even the price setters would be also in a category where there are a couple of them with a very minor deviation to that to the market pricing.
So I mean, premium and affordable housing, obviously they might be having certain margin differentials. So like to what profit margins are typically?
So if I have to place it for residential between say affordable to mid-income to kind of premium, so any affordable housing developer would be looking at least 15, 20, 25% say. So I would put it in that kind of a range. Of mid-income kind of will look at 25 to 35% kind of a range, and the premium would be upwards of 35%. So that is a very generalized way of looking at it. He may achieve, or he would look at to underwrite a project in that.
Okay. So we have covered the nuts and bolts of this real estate space. So as an investor, what should be one looking at typically? I mean, if the checks have to be on the corporate governance side to evaluate the credibility of a particular developer, or what sort of legitimacy checks need to be made to make sure the financial statements are clean. So the thoughts about it.
Yeah. So if anybody has to evaluate the real estate as a sector, and as a professional, every one of us we do focus largely on the cash flows of the project. How much the collection is happening, how much of the cost is being incurred, more on the live basis rather than relying on the financial statements. By the nature of accounting treatment, it becomes a little difficult to kind of decipher that. Having a more on ground, on the site, on the project specific focus and understanding of how the cash movement, or rather the cash flow movement is, how the sales cash collections happening, cost being incurred. I think that gives you far more rather comfort in that sense. Apart from that, obviously you need to be vigilant about what the developer is promising, whether he is able to kind of deliver. Obviously there is some deviation which is acceptable, but a far longer deviation to whatever he's proposing would be kind of a aspect to look into detail. And third thing, I would say that how many litigations, because real estate is a sector which kind of gets easily into litigation, so which would also delay your project as such. So I think from an investment standpoint, one has to look at the length or the duration of the project. How, if he or she is able to kind of complete the project in a shorter duration time, it's far more profitable rather than getting delayed, which will eat up in terms of cost from the borrowed financing or because of the increased cost. So I think very broadly one can look at that way.
All right. So just last question, or rather a recommendation, and then we'll open the floor for Q&A. So any books or anything that you have read on this subject matter which will help us understand the perspective of a developer or understand the sector better?
So there are very few material that is available on real estate, but as a professional, we do kind of read the statistics coming out from all the property consultants on a quarterly basis. I think that becomes a reference point and news articles. But there are a couple of interesting books which has been written on the real estate. I think one second. So one book that I have read is the Inside on Real Estate by Sushil Sanayasayal. There are other two books which I haven't read, but I have come to know that there's Dare to Dream on MS Oberoi, and there is whatever the odds by on the DLF. But the last book which I'm currently reading is on Zeckendorf. This is an autobiography. On a American developer. And this is kind of playing in post depression. It's a book which kind of gives you a far more insight into how a broker turned developer and what are the odds and the fame and the debacle. I think that's the book which will give you some sense in the mind of a developer. So that's the last book which I'm currently reading. So yeah.
Thank you. It was great chatting with you.
Yeah.
We can open up the floor for Q&A.
Thank you.
Hi, thank you for that. Recently, in the Western countries, there's a lot of chatter around office spaces and commercial real estate, uh, declining rentals or vacancies, etc. Any trends that you are seeing in India around this?
So, not really. If I have to specifically talk about in what I am also trying to follow is in US, there is a lot of vacancies happening in the California, at least in the Californian belt, and other regions also are getting impacted. So to speak, even the commercial real estate mortgage, because of the interest rate movement, is having its own turmoil, which is likely to impact maybe a couple of years down the line. That's what predictions are, and I'm also following that, not my insights as such. But in India, I would rather see that we are just maturing. And interestingly, what is happening is even in commercial real estate, the share of GCCs, the global uh, consumption centers, so all the back offices or the mid offices are having a larger space getting occupied in India. Now that share was somewhere about 17 or 15 to 18% in about a decade back, but now they are gaining like majority 40-50% of the leasing in the incremental leasing in the space. So we are really not there right now seeing a demand supply mismatch. Last quarter or two, I think there has been a slight mismatch, but closing 2022, if I'm not wrong, there was about 50 million square feet supply in the market and 49 million square feet which was consumed. And similarly, a year back, it was about 40 million square feet. So we are not seeing a major spike in terms of vacancies as such. But yeah, we have to still look forward for some capacities which was planned in, say, pre-COVID or during COVID, and how we are going to fare in the near future. But as of now, it doesn't look as maybe scary as what we see outside India.
Thank you. So you mentioned that
when a residential developer is trying to create, he's looking to put in probably 20 rupees of his or 20% of his and make 40 over a 3 to 4 year period. Now, when you look at listed developers, nobody's over the last 10-15 years has sort of made that kind of ROIs. So, where does that math go wrong? What typically goes wrong in that math?
So, so these are all ideal condition examples. Let me put it as a disclaimer, and I think I mentioned it to a certain extent. So what goes wrong is it's an ideal proposition when you are evaluating a project. So when I said 20, again 20 doesn't happen. That's the broad assumption that I've given. Some developer have to say a premium luxury. Now premium luxury is something you will not find takers on the day one. So you would have a product which will be like 10 crores or 20 crores. So you would have somebody, when you have look and feel, you stand up into that space, look outside. So for that you need to have a capex. So probably for that you would have 40-50 of his own contribution would be going up, and then you have to wait to the whole product gets complete, and then you have to sell it. And even in the assumptions, probably he might be optimistic at that time, say 20 or 30, but eventually he has to contribute more, or he has to borrow more, and then he has to pay. And third thing is, sometimes there is or rather in the history, because of the paralysis in terms of regulations, approvals not coming in time, or there is some in North NGT issues kind of create stoppage of works over a period of time. So there are multiple factors which could delay your completion of a project. So time being from the start to end defines your say kind of a returns that you make. So probably 2 times, but if you initially planned it for 3 years, then eventually happens in 7 years, kind of erodes your ROE per se.
Right. And so there are a couple of these real estate consultancies or, Knight Frank and all who keep publishing reports. And so there are conflicting reports, as in one of them says that you are seeing massive consolidation in the space. The larger developers are getting more share, or they're launching more and more space, while there's other which contradicts that and saying there is no major consolidation, or the mid and small players are also doing equally well. So in your view, which of them is right?
I would go by the statistics, but so again, consolidation is it's a very, very, if I have to compare to say an automobile sector, okay, whether Maruti has taken a 40-50% share, whereas the other cars put together is filling that 50%. Whether that has happened in real estate, obviously not. That is very, very difficult to kind of reach to that stage. So so again, consolidation from earlier, it was only 5% where the branded developers. Now they are reached to say maybe 7-8%. If you call it that as a consolidation, probably it's true. But compared to another sector, maybe not.
Okay, thank you.
Couple of questions. One is, there was a talk after COVID that, India will probably go to tier 2, tier 3 cities in terms of hiring, in terms of the digital world, work from home scenario. Is it really picking up where, India Inc. along with policy is going to tier 3 cities and setting up campuses or, corporate offices out there?
So, right now, if you're talking about IT as this
in general, probably, I don't know, nothing specific in the terms of sector.
So right now there is, from a residential standpoint, if I have to answer, yes, there has been post-COVID some traction in terms of going beyond the 8-10 cities, which is predominantly takes the limelight, and which is also highly covered in terms of property consultants or anybody else. So beyond this, the smaller towns, when we have a conversation, we understand there has been a certain pick in terms of transactions happening. There is some commercial activity happening, but where it has been into a transformational phase or not, it's very difficult to comment it on right now. But yes, probably more of manufacturing, more of small services kind of getting set up. We do get to hear a bit, but to make a make a statement out of it, it's probably maybe too early to say.
Second question is on the national logistics policy front. Any view on the warehousing and the cold chain facilities setting up along the DFC or policy? How are people, developers, India Inc. and policy looking at that space or along the new highways that we are building up and things like that?
So logistics and warehousing has been the hottest sector in the real estate space right now. So they are all the developers and even the foreign fund/developers have also been actively active in India. And right now, the two sectors that are kind of into the hot list is warehousing and data centers. So these are the two sectors which is getting the maximum amount of attention right now. Rather, commercial was there for a decade ago. Now it's more other these two sectors who are getting more funding. So yeah, all the infrastructure and even post GST kind of requirement of a grade A warehouses, all this was putting together in a lot of investments into having a grade A kind of warehousing setup in place.
Thank you.
Yeah, hi. So given that there has been a revival in the residential real estate sector after almost a decade, how do you see the prospects of the sector panning out over the next, say, 3 to 5 years?
So it works in cycles, and I have to take help of history or the recent history that we have seen, maybe not giving a very true picture as such. But as I showed it on the graph earlier, so we had, or rather, let me go back a bit. I think 95, 96 was the closer to Asian crisis, and this is something which I have seen is there was a sharp decline in the property prices, and from there till I think 2003-4, it was absolutely a bear market. I think equal to the equities, and same was for the real estate. Then there was a resurgence in 2003-4 till 2013. So earlier the bear market was about good 7-8 years. Then this bull market was about good 7-8 years. And then again from 13-14, I would say it was kind of had a time correction or a plateau till say 2021. Again in 7-8 years. So very coincidentally that's happening after every 7-8 years. And probably after 2021 or fag end of 2020, there was an active transactions in residential space and others. So if I have to take that as a starting point, then we are probably at a 2-year stage.
So fair to say that, the interest rate upcycle or the hike in interest rates has no or very little correlation to, the sales of residential units?
That's what I have also able to conclude looking at the graph what we had. So what we understand is basically, and what I also understand, and I will be happy to get a different view also, but it's more on the affordability is one of the factors, but more of a confidence of whether I can buy a house. That defines, and then he works on his affordability of whether this loan whether I should buy 2 crore or 2.5 crore or 1.5 crore, and then he looks for the location. So I think he or she looks at the interest rate and then does his calculation, but he makes a mind of buying irrespective looking at the interest rate.
So it's more like, per capita incomes rising have, more sort of direct correlation than interest rates.
Should be. It's about the income, whether I'm earning more, saving more, I have more. I would rather choose to buy, and again it's the need of the individual.
And one more question on RERA. So how does the builder get penalized in case he doesn't doesn't deliver according to the RERA guidelines?
So there are multiple aspects, and I think recently even Maharashtra RERA has put out notices, and even a lot of people have defaulted, so they have penalized to a certain extent. And there is also a section 8 under RERA where if he or she is not able to, then there is a provision that RERA as an authority would take control over the project, or even can assign it to somebody else to kind of, so it takes away the control of the developer. It's again getting its own motions to get it tested, but there are mechanisms to kind of penalize a developer or take away the control of the project.
I wanted to ask about the retail space where there was a REIT recently, Nexus. What are the opportunities and risks of investing in that sector compared to the other office REITs?
Um, for me, I'm not the great expert on this thing, but I'll just give you a broad understanding. Is Commercial real estate has a far more stable in terms of commitment in terms of the tenants. So tenants would typically come at a 3+3+ year, kind of a 9-year commitment. There is a very defined occupancies, and that's the nature of the asset class as a commercial real estate. So when you look at retail, it's more on the consumption driven. Whether I'm not too sure what is the tenure of the this thing, but there is a function of even you do a profit sharing. So the nature of earnings is slightly different vis-a-vis the commercial asset class. And typically, as a real estate person, you would associate a slightly premium in terms of capitalization rate over the commercial asset. So uh, because it's far more stable in terms of earning visibility, and vis-a-vis the retail. Retail can like in the lockdown. I think if there would have been a listed space on this asset would have been available, then probably because of the sentiment and the lockdown, things would have looked completely different. So I think it's a slightly riskier asset than commercial. So obviously it charges a slightly higher premium or higher cost in terms of yield expectation vis-a-vis a commercial. So probably, I hope this answers your question.
Right. Other than the major 4-5 markets, are there any trends that you're picking up in any other markets?
Sorry, which markets?
Basically, in real estate, let's say Bombay, Delhi, these are the 4-5 major markets.
Correct.
Are there any other markets which you think are picking up?
So unfortunately, this 8-10 cities, I would rather expand it to 8-10 cities where you would have Pune, Delhi, Bombay, Bangalore, Hyderabad. So these are the ones which has uh, in terms of professions getting or rather the earning per capita earnings and type of job profiles are more predominant, and that caters to the larger market as such. Beyond these 8-10 cities, they are still able to create the income source. So probably from a different say maybe industries or something that has been missing for some time, but probably in near future, because of various policies being in place, PLIs and other things, maybe that would be a trigger point, or maybe IT or other services also percolating down to small cities. Right now it's too early to comment on it, but yeah, maybe industrialization could be another trigger point in near future.
Hello, good evening, sir. Excellent talk. So, for a newbie into the real estate sector, what would you recommend? Like, do bottoms up research for a company or invest it through IPOs or REITs or something like that, whatever?
So I think I would not be commenting on what one should be buying in the real estate, but I would certainly say that one has to really do a far more thorough research on what the project is doing, because it's slightly difficult to evaluate a value or a price to a particular company purely because it's a sum of part valuation. So a typical developer would have 10-20 projects. So now you have to get down into the finding the economics of each unit and which stage it is currently at, and then ascertain value and do it for the next 10 and track it for the next 10 over a period of time, and then ascertain a value. So it's a mammoth exercise for anybody to kind of get into that. So I would just give you the easy part or the difficult part of evaluating a company. Vis-a-vis a REIT is slightly easier because it's already stabilized. Then probably you would be able to only comment whether the tenant is going to stay for the next 4-5 years, or whether he or she is going to vacate. What are the broad trends going to be like? That So a REIT would be a easier aspect for you to kind of evaluate, whereas a greenfield development project company.
So, sorry. Okay, I had a couple of questions. One was in terms of median age for home ownership. How have you seen that particular trend? And I mean residential in the sense, how has that progressed and where do you see today the median age for home ownership?
So obviously, in 2000, early 2000, so I'm going back in the bit of a history. So the mortgage availability was at the lowest, or the cost of mortgage was so high, or the penetration was so low. That was a typical mindset where maybe a generation before my generation, they would be like earning, saving, and then probably buying a house. From there to 2005, 6, 7 period, suddenly because of say income growing, or because of the mortgage availability, the median age kind of dropped. And right now, I think it is around 35 or 30. It's below 35. It depends. So I'm actually not tracking that much, but it's a function of affordability. It's a function of getting the mortgage. So I think that has come from the history as such. But now moving forward, it's all about the affordability of a family.
You have like a fix on what that
the
global
location.
number is in terms of median age?
No, sorry, I'm not too familiar.
Second question, which is to do with affordability. Is there a per capita number at which sort of, house ownership takes off? Like consumption, for example, there's a number at this consumption sort of takes off, right? So is there a number globally that has worked that at this per capita, home ownership takes off? It's a sort of like an inflection point. There is a natural trend which goes up, but then suddenly it just picks up, kind of thing.
So you're asking me for that number? Or?
Yeah. Is there a number like that? I'm just asking as.
Sorry, I'm not too familiar, because I would say at any point of time, anybody, and that's a standard assumption, would love to have an ownership, even if it is a 10 lakh house. Yeah, sorry, I'm not familiar with if there is any particular stats on that to comment on. Sorry, no idea.
Actually, something similar to that, which is to do with, for example, Western societies, you have, like kids move out by 18 out of the house, whether they own the house or they stay in a rented accommodation. It's a cultural phenomena. So, it's like saying per square feet, per person, how much do you consume in an economy? There is a cultural thing to it. In India, for example, we live with our parents and that kind of thing. Of course, that's changing. Would you know whether this is an economic variable or this is a cultural variable? That culture, for example, Eastern societies, you tend to stay more with your families. For example, Western societies, you don't, irrespective, right? Whether you own or you lease. So, is that a function of as in like per capita, and then the person sort of decides, no, okay, I want to have my own house? How would you think about that as a variable?
Probably, my guess is as good as your guess, to be honest. Is a function of individual choices. I think there are still people staying in a joint family. People are still, but there is obviously a common knowledge that there is a move from a more of a joint to a nuclear family, and that is what I am hearing. But I've not really done a great study on how that influences as such. But yes, the common knowledge is that is kind of the trend, and even developers to a certain extent, when they do a lot of their planning of unit sizes and everything, they do consider that there would be a more of a kind of a young family coming and staying, buying. So that influence, I can state that is there in mind. But how much of that plays out, it's very, very difficult to judge it.
Hi. I just have two quick questions. The first was about, the point that you made about residential being more of a consumption, possibly product versus commercial being more of an investment product. I on the, I mean, I have no doubts about the commercial side, but on the residential side, I'm a little, I mean, I have a slightly different view here. I'm just trying to seek your input here because, I mean, anecdotal points that I can make here is that, over the last 2 decades, I think we've all seen the concept or heard of or seen in large numbers the whole concept of investor flats, mushrooming, I mean, across multiple places. And also as practitioners in the space, I mean, when you see customers and their assets, there are lots and lots of people who have multiple houses, and they obviously are not all residing in them. I mean, they're all multiple investments. So residential is definitely maybe not so much in the affordable side, but the slightly above that it is definitely an investment product for most people. So the question I have here is, the first one is there any data on this in terms of share of, if one looks at especially in a Mumbai, NCR, Bangalore kind of, which are large urban centers, what proportion of residential units are actually self-occupied versus investor flats? I mean, is there any trend to it going, is there any discernible trend here which one can draw some inference out of? That is point number one. Point number two is real estate, especially in the high ticket size, was hugely subject to the cash economy at some point in time. I'm guessing, I don't know how much it's there. So I'm just seeking your view there. Is there, and therefore, because there was a cash economy there as compared to, say, other financial assets, it became the investment by default, not as much as choice, and therefore that may have been driving prices up. So the second question here is that hypothesis, is that changing, and therefore is it something that should be driving prices down at all, or do you think that which means cash economy, not being there, it all becoming white, and therefore it competes fairly, say, with other investment products, because then people have to rationally decide what makes sense, etc.
So I'll just answer to your first, run up to the first question. So when I mentioned residential as a consumption product is when I'm looking at the overall market. So obviously there are people who are taking calls on buying houses, more than one, for an investment perspective. So when I say consumption is 80-90% of the consumer demand, and I'm just giving a generalized statement. They are looking to consume, they're buying and staying in that house. But other sector or the 10-20% of the category of people who are looking to buy it as an investment is more of a investment to have appreciation in price. Whereas commercial is nobody is going to stay there, and they are more expecting in terms of earnings, in terms of rental plus appreciation. So that is the basic difference between the two. So I just wanted to make things clear. So
the first one was, is there data on occupied versus
that is
investor
possible.
flats?
That is possible. I don't think so. There is anybody probably published. I would have not come across, but there are multiple data gatherers. There are multiple agencies who are gathering a lot of this data, and they are also trying to make their own assumptions by and I have met a couple of them who kind of say that they are able to arrive at a particular estimate by looking at flats, whether the light is on or not, whether some clothes are being drying or not. So basis on that. So that is not a true indicator, but yeah, based on that, some data churning and can be done. There is no ready-made answer to that first question, but some sense could be drawn out of it. So that is that could also give you an idea about whether those units are being sold or not. So very difficult to kind of arrive at those numbers.
Sorry, we'll from the live audience and then go to the Zoom one.
Yeah. Yeah, sorry. The
Cash economy.
Cash economy. I can't really comment on that question though. But I think things are becoming far more clearer. I think earlier it used to be quite a predominant activity, but right now most of the developers, you go and try to buy a house, it's a full check payment which happens. So obviously we are moving towards far more of a matured economy, so that also kind of everything moves along with that. So yeah.
Yeah, sir. My question is, cities like Bombay and top cities like Bombay, Chennai, like do we gonna see that redevelopment as a segment going to scale up over the next few years?
Obviously possible. If the development, any kind of a structures which gets old, and if there is a change in the development control rules, say earlier if it is say 1 FSI, now they have increased to 3, 4, then obviously there is an incentive for a developer to come in and revitalize and give some additional benefit and do the development.
So how big opportunity it can be, and are we gonna see that that share has been increasing more rather than coming with especially new projects, because as land will also get saturated over the time?
Absolutely. So it's all function about the availability of the land. So especially in city like Bombay, where we are a landlocked city, you don't have more further space to go and build and create more infrastructure. So obviously the redevelopment takes the larger share, and last decade or so and further, I think that's going to happen. Whereas other cities has its own geographical advantages or disadvantages where you can grow radially. So if city center is kind of saturated, they can still go buy land and do the development. Even the city center or the CBDs do move along with that. So it's a function of various other aspects. Availability of the land is one of the major aspects. But certainly, if somebody wants to kind of stay in that particular micro market, the redevelopment potential is there. The redevelopment becomes a huge market after obviously the maturity of the structures and everything comes into the place. So yeah, that could be potential in the future.
So last question is that we are seeing that a lot of funds coming. So do you see that in warehousing, the cost of capital compared to the commercial, like the cost of investment compared to the commercial is less, and also the yields are much better than the commercial and residential? So do you see that over the next years that more investments or more projects will come into the warehouse, and like more investments will also flow over there, and we might see some slowdown in commercial?
No, so right now there is a lot of capital which is flowing purely because there is a demand supply mismatch which has been considered in the warehousing space. There is more demand being envisaged in the near future and at a much faster rate of growth which is expected. Hence, there is a lot of investment happening in the warehouse. Whereas in commercial, I think there are still developers who are exiting from their commercial portfolio, selling it to say funds. They are still plowing back that capital into commercial real estate. So again, because there is still some demand which is visible in the commercial real estate space. So I would not really say that there is capital only moving to one asset class, not the other, but wherever there is a growth opportunities, and since India is growing and there is a lot of demand for various other asset classes, all the asset classes, it's just that one is getting more focus right now vis-a-vis the other asset class. Thank you. Yes, thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.